Hey guys, welcome to the channel. Brad here. So today I want to talk about, should I short the S&P 500? Should I short the US market at this time in the cycle? Now, a lot of you have seen the big short based on the real estate housing crash back in 2008 and how there were a number of investors who made a lot of money by shorting the housing market. Now, let's talk a little bit about what it means to short, and then we'll have a better sense of the practicality of that at this point in time for the S&P 500. So shorting or short selling is essentially when you have your broker borrow shares on your behalf from somewhere. Now, they're going to charge you an interest rate to borrow those shares, and then you're basically going to sell those shares right away. So the idea is you're selling today, short selling. You're selling today with the hope that you can buy those shares back at a lower price in the future, and then you can pocket that difference, okay? So really you're betting that the price is too high right now. So practically how that works, say you want to short sell a stock that's $100, okay? So you're going to put up $100 of collateral with your broker. They're going to borrow that share from somewhere, you're going to sell it, and you're going to be charged an interest rate. Now let's say immediately that stock drops 50%, and you say, okay, that's about where I thought it was going to go. We're going to close this out when it's down 50%. So you buy that share back for $50 and you return that share to your broker. And they say, okay, here's your original $100 back and here's your $50 profit. So you made a 50% gain because the stock dropped 50% right away, okay? So when you talk about the S&P 500, that's probably the best case for shorting the S&P 500, is that it goes down 50% very quickly. It's hard to imagine the S&P dropping by much more than 50%. You know, if you look back historically at past crashes, it drops about 50% in a crash. So kind of your best bet shorting the S&P is making about a 50% profit. The problem with shorting is that the market can go up from here. There's nothing that says the market has to fall. Even if, I mean, as we're seeing now, unemployment numbers are skyrocketing. You know, there's no sign of when people are gonna be going back to work, when these shelter-in-place orders are gonna be lifted. So we have no idea how this thing is gonna unfold. And we have no idea even if the situation gets worse, that the stock market is necessarily going to follow. You know, there's all this stimulus happening. We don't know exactly where that's going, but some of it could be going to kind of inflating the stock market. So we just don't know. And the problem with shorting is if the price of the asset that you're shorting goes up in the short term, then your broker can give you margin calls, which is basically saying, all right, look, you're really starting to lose money on this thing because you're betting against this company and it's going up. So you've got to put up more collateral, okay? So they'll say instead of $100 of collateral, now you've got to put 150. Now you've got to put 200. And the problem with shorting is your downside is unlimited. There's no limit to how high a stock can go, okay? So you put up $100, I mean, the thing could go up 3, 4, 5x. Not likely the S&P 500, but if you're talking about a company like Tesla or an individual company, especially one that's as unpredictable, one that's in startup mode, rapid growth mode, like Tesla, there's no telling how high it can go in the short term, okay? And now what happens when you have a short squeeze is that the price of the stock is going up, 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 and investors who have shorted the stock want to get out. It's too risky. They just need to buy back those shares and return them. And so there's all of this buying pressure to settle these short sales. And that's what can really push the price up, because you have all of this buying pressure to close out these short positions. So, that's one of the dangers with short selling, is that, even if your thesis proves to be correct, if the market goes down, it can go up before then and squeeze you out of the position, okay? Warren Buffett always says, or he has said at one point, he's always been right about the companies, that were Ponzi schemes, or companies that he knew were going to go down, but he's always been wrong on the timing. And the timing is all important when it comes to shorting or short selling. That's a big challenge with shorting something like the S&P. I mean, you saw in the movie too, The Big Short, how Michael Burry, it was clear that there was a housing crash coming, but the price of these securities that he was shorting kept going up. And so he kept having to put up more and more collateral. And it's a really terrifying situation. As you saw, it was very stressful for him. So, the idea of shorting the market, I think there are much less risky ways to make money as the market is going down than to short the market. One of them would be, if you think the market is going to drop by 50%, it's at around 2,800 now, the S&P 500. If you think it's going to drop, why not just say, okay, I think it's going to hit this price. It's going to drop 50%. I think it's going to hit 1,400. And just wait until it hits 1,400 and then load up on it. And so you're not making money on the way down. You're making money by buying it cheap and then making money on the way up, which is much safer. What else? There's one more thing. So Monish Pabrai, who I'm a big fan of, he's my investment mentor. I watch all of his YouTube lectures where he does guest lectures at business schools around the world. He came out with a video maybe a year and a half ago, called The 10 Commandments of Investment Management. And one of those 10 commandments is, thou shalt not short. And he's vowed to never short a stock in his investing life. And the reason is, I've kind of already covered this, but your maximum upside for a short is a double. So you short that company at 100, it goes down to 0. You get your collateral back and you get your $100 in profit back. So you've gone from 100 to 200. You've doubled your money. So that's the maximum upside. The maximum downside, there is no maximum downside. You can keep losing money. It's infinite maximum downside. So when you make bets where your maximum upside is a double and your maximum loss is bankruptcy, you're not going to be in the game for very long if you make too many of those bets, okay? We should be finding bets where our maximum downside is, say, 20%, maximum upside is 5 times. Like, that is the kind of asymmetry in reward to risk that we're looking for as investors. And you might say, well, that's kind of crazy. Like, how often are you going to come across opportunities like that? Well, we don't need to come across many opportunities like that. If we get one a year, even one every couple of years, that's all we really need to knock it out of the park as a value investor, as an investor who's looking for these bargains in great businesses, these large margins of safety. So, you don't need to be super active. And that's the mistake I think a lot of investors make, is that they want to bet on everything. They see, the stock market, I think that's going to go down. How do I bet on that? How can I, make money on that as quickly as possible, rather than having patience, waiting for it to drop, and then just buying cheap. And that's a lot less risky way to do it. It does require more patience, but in the long run, it's, just looking at Warren Buffett and Charlie Munger's track record, other value investors, it's really a proven way to do well in investing over the long term, is to be patient, swing when you get a great opportunity, and wait for that opportunity to play out. Wait for the stock market, wait for the auction-driven stock market to price that asset in accordance with what the underlying value is. So I think that's all I have to say about shorting. There's another guy I follow, Aswath Damodaran, and I was surprised he shorted Amazon. I think it was a year or two ago. And I was quite surprised that he did that. He seems like a very rational investor. And my only rationale for why he might have shorted Amazon was he was desperate to do something, right? He was tired of waiting to find these bargains, waiting for these bargains to come along. It's hard to wrap my mind around. But anyway, thou shalt not short. Let me know if you disagree. I know there are leveraged ETFs that you can use to short and to kind of minimize your downside to only what you're putting up. I haven't looked too much into those, but I'm sure there are opportunities there if you're quite sure that the market is going to drop in the next 6 months, year. So those are things to consider. They're not for me, but there's plenty of options out there if you want to bet against the S&P 500. So I think we'll wrap it up there, guys. Let me know if you are shorting anything at the moment, how you feel about shorting in the comments. This is fun. I love chatting about this investing stuff with other investors. So hit me up there. I'll respond to each one. And that's all I got, guys. Stay safe out there, and I will see you in the next video. Take care.